Valuation is much more of an art than a science. There are numbers involved, but it's ultimately a negotiation between people, and it's derived in a lot of senses by conditions in the market and lots of other things. There are numbers involved, but it's not just purely mechanical and mechanistic. There's other elements that go into it. And so when you hear people talking about valuation, there are lots of other ways to value businesses. And to make it really simple, we're going to give you the one that's from an 80-20 principle standpoint.
Hi, I'm Tom Shipley. For those of you who don't know me, I'm co-host of DealCon CEO M&A Summit. I bootstrap my brands to generate over $2 billion of revenue. I was the founder of both an agency aggregator and e-com aggregator, raised over $150 million, and had 18 exits and acquisitions. And I'm here with my friend and co-host of DealCon, Matt, to talk about programmatic M&A.
Tom, super excited to be here. For those of you who don't know me, my name's Matt Bodnar. I'm a private equity investor. I've done more than $100 million worth of transactions. And as Tom said, he and I are co-hosting the DealCon M&A CEO Summit. And we're going to talk today about deal structure and how to put deals together. But one of the most important pieces of deal structure is understanding how companies are valued. Right. And this is often a topic that seems like it can get really complicated and confusing. And you start hearing people throw out terms like discounted cash flows and depreciation and all of these fancy accounting terms. But I like to really dial it back, because if you boil valuation down, and I think one of the most important elements of really understanding and unpacking valuation is this notion that valuation is much more of an art than a science. There are numbers involved, but it's ultimately a negotiation between people, and it's derived in a lot of senses by conditions in the market and lots of other things. There are numbers involved, but it's not just purely mechanical and mechanistic. There's other elements that go into it. And so when you hear people talking about valuation, there are lots of other ways to value businesses. And to make it really simple, we're going to give you the one that's from an 80-20 principle standpoint. This one method will get you 80% of the way there or more for most transactions, which is really simply just looking at two fundamental things. One is the earnings of a business. How much does the company make in profit, right? And there's some things maybe we'll add to that or subtract. Maybe we'll try to get to cash flow. The term you'll hear thrown around a lot is EBITDA, or SDE, which stands for seller's discretionary earnings, or earnings before interest, taxes, depreciation, and amortization. All you really need to know is those are basically proxies for how much the business makes, right? And there's some reasons why they're good. There's some reasons why maybe they're imperfect, but they work reasonably well. And so we take the EBITDA, or the earnings of the business, and we multiply that by a multiple. And that's probably the most common back of a napkin way to get really, really close to a business's value. And just those two pieces of the puzzle, if you can just get a multiple for your size and industry, and you get the earnings or the EBITDA or the SDE of your business, combine those two things, and you have a rough sense of the company's value.
Another thing I'll add is, and this might be even more simplistic way of looking at it, is when you're buying something, you want to say, how big of a bet I'm going to make on this business, and is it a good return? So, such as, how many years of cash flow am I willing to bet to buy this for? So am I willing to say, I'm willing to bet, and I'll buy it right now for the next 2 years of cash flow, or the next 3 years, which that 3 years means 3 times your annual EBITDA or ST. So that's basically what we're saying. And I can get a multiple of return on top of that bet that I'm taking for how many years. If you can't predict that this business is going to keep on generating the same level of profit for the next 3 years, well, maybe you should not be paying 3 times EBITDA for that business. And plus, remember, you always have to return on top of that. So Matt, what I'd love to talk about a little bit is the difference between a seller perspective and a buyer's perspective, because it really dictates everything we're talking about DealCraft. And the challenge is that we all value our business in a certain way. And if we're buying businesses, we are more bullish about the future. We're more aggressive, so we put a value onto our business at a fairly high level. A seller might not be having the same interest or idea on it. And let me bring an example from a totally different field, but this is a real example. There is a gentleman who sold his business, I believe it was for over $100 million. And suddenly he realized that in order for him to save money, I'm not saying whether this was right or wrong, but on his taxes, when his plan was to move to Puerto Rico. But based on when he closed, he needed to sell his house and all his possessions in that state of Tennessee within 48 hours. So he took a massive discount on his house in order to someone that would close with primarily a cash deal that quickly. And I believe it was like 50% of the market value. Now, remember, here you have the buyer who was in love with that house, who would have gladly paid market. You had the seller that had to get out quickly and put a premium on a quick close. So they were able to buy, the buyer was able to buy it for 50%. Now, if that same buyer was going to sell the property, they sell it at a higher market. So again, don't ever put yourself into that box. And another analogy that I shared with you, Matt, earlier was we had a business. It was a skincare business. It was not relevant for our business anymore, and it was distraction. It was generating $5 million of revenue and about 20% EBITDA. It was a distraction to us, and we just wanted to either close it down or do something with it. So we found a buyer who was willing to buy it for the inventory we had in stock and would pay for the inventory as he used it. And we had a lot of reasons for our business. Our business is doing over $100 million a year. This was small, really non-essential, and a distraction. So that's what we did with that business. Now, the average person would say, oh my God, a business, it's making, in that case, $1 million a year. We should be paying then 3 to 5 times that. Okay. We had reasons we need to get out of the business quickly, which we did, and that's why we do it. So don't ever assume that the seller's attitude is the same as yours.
Yeah, those are great case studies too, in showcasing the importance and the difference in terms and structure and how terms can massively impact a deal, right? Because the house example is a perfect story of, hey, houses are generally relatively price transparent, right? We know within a pretty close band what a house is worth. It's publicly available. You can go on Zillow and look at it. Certainly houses trade above and below those prices, but it's a very transparent market where there's a lot of price visibility, whereas private businesses are the total opposite. It's complete Wild West. It's in the dark. It's very unclear. Valuations can have a much larger range. But even in an incredibly transparent and liquid market like homes, a deal structure element, to use a fancy finance term, a deal structure element, in this case, the closing time frame, meaningfully impacted the price, right? And there's something that a lot of veteran deal makers will talk about, which is the concept of the law of price and terms. And the idea is basically you can flip it either way, but it's if you name the price, I'll name the terms, and vice versa, right? So in this case, the terms were, hey, I need to sell this thing in 2 days, right? And the price was 50% off of retail or 50% off of the market value. And that's a great illustration of how those things can interrelate with one another, because on a lot of times what you'll see is somebody wants to achieve a certain price for their business. And in order to get there, the buyer of the business will often introduce some terms, or another synonym for terms would be deal structure, to get the business to that price point, right? And in that case, it would often be things like an earnout or seller financing or rolled equity or some combination of all of those things. And so when you look at the deal maker's toolbox for methods or strategies to solve for both people's needs and pain points, because at the end of the day, that's really what doing deals is all about. That's really what structuring deals is all about, is understanding. I look at it as basically a Venn diagram between what am I trying to accomplish and what is the other party trying to accomplish. And whether I'm a buyer or a seller, and I've been both, I know you've been both, depending on if there's enough overlap in the middle of that Venn diagram, you can get a deal done. And if there's not, then you really can't. And you could be the best or the worst negotiator on earth. But if you don't understand and shape a deal space that fits both parties' mutually aligned interests, it's really hard to ever actually get anything across the finish line.
We talked about this earlier also, is that we talked that 90% of businesses that go to markets will never sell. Even if they have term sheets, they don't close. And if you've been in your business for 20, 25 years or 30 years and you're tired and want to retire and you're unsuccessful at selling it, what do?
Close it down, more or less.
you turn it over to your employees or something.
Yep. Do an ESOP. Yep.
There are more and more businesses that are out there that fit that criteria where the owners are burned out and they're done. So therefore, there are flexible terms. And if that's where I am as an owner and someone offers me, Tom, I love your business. I'll continue operating it for years. And I'll tell you what I'll do is I will pay you above market for the business. You know, the market is 2 times your annual cash flow. I'll give you 3 times if I can pay you through it's making 20% margin, EBITDA. I'll pay you 10% EBITDA. Basically, this price would be 10% of EBITDA of basically, or 10% of revenue for till it's paid off at 3 times. As you said, my terms, your price.
Yeah, Tom, that's a great example of what I would call a business giveaway, which is basically somebody's going out of business or closing their company down. A lot of times it's the same thing you did with the skincare business. A lot of times it's more advantageous for them to figure out an easy path to get out quickly and extract a lot of value. And really the first add-on acquisition I ever did for one of my companies was a guy closing down his business. He had a much bigger business and he was just getting out of a low revenue business doing a couple $100,000 of revenue. And we bought it from him for 10% of revenue for 3 years. Nothing at the closing table other than that. And I see this all the time, especially in the agency space, where people are burned out. They have an agency that's doing a couple $100,000 of revenue and they don't want to just throw it all away, but they like to find some home for it so they can go do something else. And those deals there are tons of those deals out there for somebody who knows how to look for them. And occasionally you'll just bumble your way into them like I did for my first deal. But if you're really thoughtful about it, you can find a lot of them.
So I'm going to throw out just to start a conversation on different deal structures, on a deal structure that we like a lot and we've done, which is in the agency world, we find these more mature businesses where the owners want to exit, but I always would like to have an opportunity for the owner to take some cash at close. And there's 1,001 way. We'll talk about how to fund the cash in a minute, but let's separate that. And it could be 5% of the value, 10% or 20% cash at close, but that would be just what the seller takes at close. Then I divide it into 3 pieces. 2 pieces essentially. There is the cash consideration, and then there's the rollover equity. Okay, the cash consideration is divided in 2 parts. One of the cash consideration is payment at close, and the other cash consideration is my seller note. Basically is how much money we'll pay the seller every month for a certain period of time with certain interest that we agree on. And my discussion with them is you're going to get more than a market rate on the interest, and we're going to make these monthly payments there. And by law right now, I think it's about minimum is 5% anyways. So they're going to be 5% per year. So again, it's a great way to structure it. Let's just say it's 10% cash. It's another 50%. You do a seller notes over 5 years. And then third piece is it's basically a way to participate in the upside. And you can structure rollover equity into only their agency or their brand. You can do structural rollover equity that actually converts at the parent level. I don't want to get too complex on this short of time to do that, but those are different ways that I like to do it. But the one thing that I will share with you, if you're doing monthly payments, if there's a way that you can protect yourself by structuring the monthly payments so that if there is a downturn of revenue on the business, that the payments, that there's a true up and the monthly payments adjust. So you don't end up in trouble that the business can't cash flow the payment. Now, for the seller, I'm saying that I told you you're going to get $2 million of a seller note, period. You're still going to get this $2 million. You're still going to incur 5% interest on the open balance. However, if the business actually performs less, or basically some of the clients leave, whatever happened, it doesn't the cash flow, we're going to just stretch those payments out because you don't want to put the business in jeopardy and your employees in jeopardy.
Yep. Yeah, I couldn't agree more. That is one of my favorite deal flow tactics, strategies, is to have any kind of ongoing contingency payments, seller notes, whatever, have some sort of performance clause. That's basically, I usually set it as a revenue threshold. And I'll often have it give them a little bit of a buffer, but if revenue falls below a certain threshold, payments go into some sort of a crewman or deferral, where they're not taking on an ongoing basis. And that to me is a really, really important piece of most deal structures, because I've done the opposite too, where you agree to some sort of payment structure and then the business materially performs differently and you're locked in on a fixed number. I don't do that anymore. I only structure them as a variable component based on the business's performance. And I think it's, for a savvy deal maker, that's a really, really important way to structure a seller note. But I think, unpacking what you were saying a second ago, there's a couple building blocks of deal structures the way that I think of them, right? And so if you really think about the tools that you have available as a deal maker, and especially if you own an existing business, there's a ton of different tools out there, right? So you've got cash at close, which is one piece of the puzzle. And we've already shared a couple examples of deals that didn't need any cash at all to close, right? And those are always really interesting. They're not necessarily every transaction, but it's great to know that you can structure deals that way. So, cash at close is one element. You've got a seller note or seller financing of some kind is another element. You've got an earnout, which is similar but not the same to seller financing. And there's all kinds of super creative ways you can structure earnouts to both kind of match a valuation gap and also create some upside for the seller, or some downside protection for yourself. And then you've got rolled equity or seller equity, which is basically the seller keeping some stock. And as you pointed out really astutely, Tom, there's a couple ways you can do that, right? So you can have a seller keep equity just in their business unit if it's merging into a larger company, or you can have them keep or get equity in the whole parent company. And depending on what they want, what you want, those are different variables that are available. There's another sort of element you could throw in there too, is thinking about your company's stock as a form of consideration as well, right? So you can do a merger with another business where you're putting up, you're not taking out any debt, you're not putting in any cash, and you're only trading stock. And so there's lots of different puzzle pieces here that you can play with. And every single one of those, we just shared one example of a seller note and how you can tweak it just a little bit to substantially reduce your risk as a buyer. Every one of those elements has a whole playbook, a whole rabbit hole of strategies, tactics, opportunities you can use to optimize them or configure them better to hedge your risk, to match buyer and seller interests, and to get deal structures that really work for both sides.
Okay, so we're gonna have fun for about 3 minutes, okay? For our three last minutes. And here's what I suggest is we're gonna go one by one on where to get money from in order to buy a business. Okay? I'll go first. It's high interest, but you can close within the matter of 48 to 72 hours, a revenue advance loan. There are a number of people that will give you revenue advance loans that's typically 1 to 2 months of revenue of a business, and you can do a quick close on it. And if it's a fraction of your overall purchase price, because basically of what you actually have to close versus with seller notes, it can be an economic way to buy one and certainly a close.
Yeah, that's a great one and moves very quickly. I'll throw out probably the most common financing methodology in the smaller deal size, 5 million and under, which is SBA financing. It takes a little bit of time, but it's some of the most advantageous terms. And you get up to 90% of the deal financed with a single lender, up to $5 million in aggregate.
Okay, so if you're buying a business that has assets and receivables, you can do an asset-based line. There are a large number of asset-based lenders out there that will typically give you on inventory up to 50% and off of your accounts receivable, 80%.
Yep. Another one, obvious, but cash on balance sheet, right? If your company has cash reserves, a lot of times you can deploy those into purchasing another business and can be one of the highest and best uses of your capital from a return standpoint.
A lot of times the business has assets, that they have physical assets. You can also get loans against the physical assets that are there that you're buying.
Another strategy would just be investors, finding investors that you could raise capital from and those could be friends and family, they could be institutions, to provide additional capital for the deal.
There are a number of lenders out there that will give basically loans on cash flow, okay? And it's more of, you have to think about stacking your deck, and sometimes you can actually combine several types of financing together. So you can get an asset-based line as well as a cash flow line. The asset-based line is higher and more senior than the next line, but you can also there's plenty of lenders out there that will do cash flow, that will actually do cash flow lines on your business. And typically the debt ratio that these people are looking for is how much debt to EBITDA can you borrow. Typically it's easy in the 2 times range. 2 times your annual, and then some will go 2.5 to 3 times.
Yep. I'll throw another one out that works really well in the e-com brand world, which is buying inventory on consignment. In fact, you sold a business that way, Tom, right? Which is pay me for the inventory as you sell through it. It's a great way to solve a gap around inventory value or get a business purchase where you're not having to put any capital out to buy the inventory.
And I'll throw this out as you look at their balance sheet, what you want to look at is some other things such as, do they have real estate? If so, can you separate the real estate? Can you do a deal differently? Can you borrow against the real estate? And doing it that way. And the other thing that I saw once is that I looked at a deal where it was a great business, bad balance sheet. So the owner was not able to restructure the loan, but the new company coming in, because they had an existing business, went to the lender and was able to restructure the debt, including additional capital to buy out the business. And therefore they can support the notes where the prior business cannot. Matt, I think we're out of time. I think that does it for us for today. It is such an exciting thing. And let me put it this way: this is just the beginning of a dialogue that we're going to have. And my favorite thing is we're going to be spending 3 days in Nashville from September 23rd to 25th at DealCon M&A CEO Summit. It is for CEO and founders that are on fire, primarily from the agency and people that own brands, where Matt and me and a number of leading experts are coming in. We're sharing everything, and the most valuable thing is most of the people, you could not pay them $1,000 or $5,000 an hour to sit in a room with them, but they're there at the event. Steal the time, sit down with them, get their advice, including our M&A attorneys. Matt, what do you want to add?
Yeah, I would say the same thing. This is the very, very tip of the iceberg in terms of deal structure, how we think about buying businesses, and how to apply M&A as a really, really powerful growth strategy for your business. So if you're an agency owner or an e-com brand owner and you want to take your game to the next level, come and hang out with us for 3 days in Nashville. It's going to be me, Tom, and a room full of really savvy experts, at most 100 business owners in the room. And we're going to teach you A to Z, everything you need to know about how to buy companies and how to scale using mergers and acquisitions.
Matt, where can they learn more about it?
They can go to DealCon Live. Is that it? Sorry, I don't know the URL. DealConLive.com. They can go to DealConLive.com to check it out, sign up, and come and join us in September, the 23rd to the 25th in Nashville. We'd love to come and hang out with you.
And by the way, feel free to DM us on our socials.